Good morning, and thanks for joining us here on Treasure Coast Solutions. Every Wednesday, we talk about things that are affecting you here locally, but maybe some of the things that are happening internationally or nationally that will have an impact on you locally. The show is really about finance and economics. It's not a financial planning show. I'm not going to tell you what to buy, what not to buy. We're not even going to really get into that most times. Most of the time, we're talking about economic issues and some of the things that impact you or will impact you depending upon the choices that people make. And I know I just saw recently, well, first of all, my name is Mark Breckbill. For those that are new to the show or haven't caught the show before, I'm a CPA, ex-banker, and have some training in finance and economics over the years, particularly in the banking days, but also as a CPA, and have been involved in that type of activity for a long time. And so it's given me I think a little different perspective sometimes because I've had to live it. And it's like with anything. It's not that people don't understand it necessarily, but you can understand it better when you've lived it. And some people don't necessarily have that opportunity. And so some of the things that are happening right now in Washington, in Europe, are impacting us, but we haven't really seen it. So, we may understand theoretically what's supposed to happen, but we don't always realize what practically that means. So, it's uh, it's an opportunity here on Wednesdays for us to kind of air some of those things out. And if anybody has, I don't claim to be an expert on this issue, on all these issues. So if you have a comment, you're welcome to call 220-9788 220 WSTU, and I'll have Evan hang up on you. So no, but no, I will take your calls. Please just be civil, and if if you want to talk about something, that's fine too. Again, that's my background. So I think some days I've been fortunate. I spent a lot of time, and I've mentioned this in the previous shows. I spent a lot of time in the banking industry, and one of the things about the banking industry can be frustrating because it's so heavily regulated. So many times uh, when you do something, your actions are not always uh, there's not always a direct outcome that you can see because of the intermediary steps that take place that are government regulated, so that sometimes the steps you take, they're still going to produce the answer that you want, or maybe that you don't want, but it's still going to produce the same answer, but sometimes it takes longer to get there because of government regulation, government interference, and some of the things that cause that to corrupt the process. And I mean that in from an economic standpoint, in that it keeps something from happening initially the way that it should, and then causes people sometimes to make bad decisions based on those intermediate steps. So we've been talking a lot about the new tax bill, and that is something worth talking about. Uh, but also, I do want to look at some other issues here, and I want to talk about some local things too, because I think it's important to bring some of this stuff back to where we're at locally. But I did want to mention, they're still fighting over this new tax bill, and trust me, no matter what they call it, uh, they whether they call it a infrastructure, a human infrastructure, or whatever infrastructure, this is a tax bill. It really is. It's primarily, and that makes sense because, as we've talked about on the show previously, the U.S. Supreme Court, through really one person, Chief Justice Roberts, uh, made a determination that basically the government, and then particularly the House of Representatives, could do whatever they wanted as it related to taxes, as long as it was tax related, uh, and it had a tax purpose. So, for example, and just as a refresh, that was during the Affordable Care Act. So President Obama, in his first term, along with the House and the Senate. Remember, the Democrats controlled all of that at that time. They passed a bill that was designed to force people to take to have health insurance, um, and and that was its purpose. It made it mandatory that you had health insurance or you faced a penalty for that. And so that was challenged, and it made it to the Supreme Court pretty quickly. And the question was, is it does the government have the constitutional authority to be able to force somebody to take an economic action, to force somebody to buy health insurance and make them have it? Do they have the ability to do that? And and President Obama and his administration, they argued that they absolutely did, that this bill was perfectly constitutional, and that it had and that they had the ability, Congress had the ability, to force people to have health insurance. Keep in mind now, this was not an executive action or one of those kind of things. This was a true bill that went through. Remember the Nancy Pelosi, you got to pass it to see what it says, comment. Well, that's the bill, and it was passed. It was passed by, because remember, the Democrats had both the House and the Senate and the White House at that time. They had all three things. So it passed as a bill, and they truly believed that that bill would be successful. And now keep this in mind, and this is something to look at and real, because it helps us understand where we are today. Uh, the Democrats at that time thought that they had passed a legitimate bill that allowed them to basically determine what people had to do, to determine what people had to buy, what they had to spend money on, what kind of coverage they had to have. And so, and they heard the U.S. Supreme Court. So this went to the U.S. Supreme Court as a bill that was legitimately passed by Congress, but was challenged to be unconstitutional. And the U.S. Supreme Court ruled it unconstitutional. People forget that because because it didn't get rid of Obamacare, it didn't get rid of the Affordable Care Act. People think that the courts ruled in favor of it, that the court said, no, you can do that. They did not. And in Chief Justice Roberts' opinion, because he wrote the opinion for the majority, it was a 5-4 vote. He was the swing vote. He was the majority. And in his opinion for the majority, he wrote that it was not constitutional, that that you could not, but that the bill was legitimate because it was not a bill that was forcing people to buy health care. It was a bill that was taxing people for certain actions. And so he ruled, along with the Supreme Court, that it's okay, that the government has the unlimited authority, basically, to force people to take certain actions if it's a tax. If it's a tax. And even though the administration at the time was arguing it was not a tax, Chief Justice Roberts argued it was a tax. He actually made the argument for the federal government, for the president, and that's how that law stayed law. That's how it remained in place. Now, so what happened there is the U.S. Supreme Court pretty much voted that government has the power to tax, and that they can do what they want to do as it relates to the power of tax. That was a scary thing. People don't realize this government is run socially by the tax code, has been for probably 100 years, ever since government figured out that they could accomplish certain social behavior by taxing it or by not taxing it. We have used the tax code for social action. Some of that fully supported by Republicans, some of it, but all of it to direct activities. For example, the federal government probably can't say to every person in the United States, you need to sell all of your stocks and all of your bonds and pay tax on them and then reinvest them to keep the economy going. But what have we done over a number of years? For a long, long time, we have had a different tax rate for capital gains, long-term capital gains, than we have had for ordinary income. What was the purpose of that? Well, it was the purpose of it was to keep people from sitting on their stocks, because if you're going to pay tax and you're going to pay 40% tax or sometimes higher, then why sell the stock? Just let it go, because as long as that gain isn't realized, as long as you haven't sold that stock, you don't have to pay the tax. Now, keep in mind, that's how our system normally works. When you actually sell the stock, and then thus you have cash, because up to that point, all you got is a piece of paper. So you sell the stock, you get cash, and then you pay the tax. And that makes sense because you got the cash to pay the tax. Now, if the tax was high, let's say 40, 50%, including maybe state taxes, but even ignoring that, say you're 40 or 50% in federal taxes, I'm going to let that gain ride. If I really think I've got a good stock or a decent stock, I'm going to let that gain ride, because if I sell it and I take a 40% haircut, I have now only 60% of my money to reinvest, which means I have to take more risk. I have to generate a higher return to make the same amount of cash as I did before. So taxes do affect behavior, big time affect behavior, even legitimate, what we would consider legitimate behavior, selling stocks. It has a big impact on that as to what kind of tax. Selling your business has a big impact on whether somebody sells a business right now, what's happening with the tax laws. So it's important to understand that process and how it has worked. And it has worked, and it's been used by every administration in some form or another to encourage people to do certain things. What the progressives in the Democratic Party, so I guess that's kind of the same statement. It seems like they're all progressives at this point, but let's give it a little bit of benefit and say, let's talk about just the socialists or the progressives. They learned that from Chief Justice Roberts. The thing about politicians is sometimes they're a lot like your dog. Um, you know, sometimes hard to teach the old ones new tricks, but if you keep rewarding them often enough, they will eventually learn. And that's what's happened. You know, Bernie had fought the hard fight for socialism, for universal income, for universal health care, for a government-provided health care, for government-provided education, for all of those things, that government child care, government schools, government everything. Bernie has fought that fight, and he's fought it hard, always, and he always loses. He's always lost because, in general, the bulk of the population doesn't believe in socialism. We still have a vast majority, if asked, don't want a socialistic system. They want they want something that they think is a free market system, is a capitalistic system. So they don't want they don't want socialism or communism. So, but he had continued to fight that fight because he's an old dog and it's hard to teach him new tricks. But I got to give Bernie credit. He learned from the Affordable Care Act because he truly believed that was legitimate, that was a legitimate thing, and so he has focused now not at all on passing laws that promote universal income or have universal income, that have universal health care. He has not done anything you haven't seen any recommendation of any bills for that. Why? Well, because he's now on the Senate Budget Committee, I believe, but he's the one writing these tax bills because he learned, even if he believes that it's constitutional, he knows now from the Affordable Care Act that it may not be, and there's a pretty good chance that with the court the way it is now, it will be ruled that it is not. But there's already a ruling that says that taxes are okay. So he's moving us right there. So you're not going to see universal income come out of this progressive group anymore. They have learned their lesson. You will not hear them talking about those things. They they will talk about uh, providing credits, earned income credits for those people who make under a certain amount of money. They don't tell you when they're saying that how much under that certain amount of money is. It's about $200,000. So that's as close as you can get to universal income. I mean, they're taxing it away from everybody else. So, and then going to give earned income credit to those people making, under 180 or $190,000, and that's a refundable credit. So what it is, so instead of saying here's $1,000 a month of universal income, they're going to say to you, here's $1,000 a month of earned income tax credit that we're going to pay you in advance. And you know what? When you do your tax return, frankly, we don't care how much money you make. You're still going to get that earned income credit. But it's a tax. It's a credit. It's a credit based on you having earned income. But it doesn't have any. It doesn't have to be something that they take from you. See, they also something that they can give you, because there are tax credits for energy, tax credits for housing. Are you following now what's going on in this bill? This bill is nothing about implementing subsidized housing, implementing subsidized incomes, implementing subsidized health care. It is not about that at all. It's about providing tax credits for housing, tax credits for working or not working, tax credits for kids, child care. Those are just credits. That's not universal income. That's not free health care. Those are credits. And that's allowed. The Supreme Court said that is allowed. So that's what's happening. You have to understand what they are doing, in this whole process, what they are doing economically and how they're doing it. They're doing it through the tax code because they know from 100 years that taxes affect behavior. And if what they want is an outcome that is reflective of behavior, they can get it through taxes, through tax credits or additional taxes. So they've increased taxes on some people so that those people lose their income. They have increased taxes on certain activities, like, for example, oil and gas. They haven't said that you cannot, they did not go out and prohibit oil and gas. So and this is why this is so scary. This is why this is one of the worst situations I think we've had ever as it relates to becoming a socialist country, is that nobody's talking about socialism. You're not hearing anybody say we're going to get rid of all of the natural gas. We're going to get rid of all. Now they've shut down pipelines, right? They've shut down the ability, but they haven't said you can't produce it. They haven't said that you can't. You're not allowed to own that. You're not allowed to do that, or that the government is going to take that over. They're not saying that. But you know what they are saying in that bill that they're not telling you the details on. So you say, well, if they're not telling you details, how do you know this? Because the president laid it out in what's called the Green Book. That was laid out in April of this year. And in that, President Biden, puts together a budget proposal to show what he plans to do, how much it's going to cost, and how much he's going to pay for it, and the why. And that's all laid out in there. And all of the details are fleshed out in that. Now, those details are not being discussed in the House and in the Senate. Those details are not being discussed as part of this $3.5 trillion bill. They're not being discussed there. Why? Because they do not want you to know that that's the plan. Because some of this stuff doesn't even require anybody's approval. The fact is that the IRS is so powerful, they have so much authority that they can implement much of this without even having Congress do anything. For example, the IRS has the ability to issue revenue procedures, rev procs they call them, revenue rulings, which are interpretations of tax law. So it and those and they have the ability to do memoranda, general counsel opinions, but in general, so what they have the ability through a revenue ruling, they can take a previous tax law that probably was relatively general, because that's how Congress typically writes these things, and they tell you how to implement it, what it really means. So they interpret it. Sometimes they interpret it 100% differently than 100% differently than what was intended. For example, we had the CARES Act. The CARES Act gave money to businesses to pay people. That was its sole purpose. Give money to people, give money to business, let them act as the unemployment office, pay people for not working or working, whatever, or pay them more even for not working, for take and get them money in their hands. That was the whole purpose of that. And then the business wasn't going to have to pay tax on that, because uh, the business wasn't making income off that labor because everything was shut down. So that wasn't the purpose. The purpose was, if you do this, you follow these rules, your loan will be forgiven. Well, the IRS came out initially on that and said, well, yeah, Congress said your loan will be forgiven, but we have this other tax law over here that says that if you have tax-free income, you can't deduct the expenses associated with generating the tax-free income. Now, why is that in there? That was in there so that people couldn't go out and borrow money, investment money, borrow money that they got a tax deduction for the interest, and then let them go ahead and buy tax-free bonds and not pay tax on the income. They didn't want you to be able to leverage the tax rates, because if I could do that, I could then easily just make money. The bond doesn't have to make any money. I just make money by the tax effect. I get a deduction over here at 30 or 40%, and over on the other side, I don't pay any tax on the income. That's why that was there. But the IRS decided that's what Congress intended for this PPP loan. And so therefore, they came out in a memorandum and said that, you know what? All of those salaries expense aren't deductible. So yeah, you don't have to pay tax on the income, but the salaries expense isn't deductible. Well, wait a minute. If I can't deduct the salaries expense at all, um, some of that is legitimate. People are working. I can't deduct my expenses. So that was their ruling. And it wasn't until Congress had to go in and specifically tell them that no, that's not what that's intended to do. This is what it's supposed to be. It's free, and it is not taxable. The wages are deductible by the business. They can deduct the wages, but that was not the way the IRS interpreted it. And had Congress not stepped in, absolutely that would not have changed. And we as CPAs were dealing with that right up front, because we knew that that wasn't really the intent. So that's an example of how powerful the IRS really is. They actually can get the exact opposite outcome that you intended through rules and regulations. So this bill first of all increases the number of people that will be hired by the Internal Revenue Service. I believe right now, the numbers I've seen is there's like 85,000 employees at the Internal Revenue Service. Let me say that slowly. 85,000 employees. 85,000 employees at the Internal Revenue Service doing nothing but collecting taxes from you. All right. That's bad enough. Now, this bill provides them with money to hire 87,000 more, not 2,000 more and go to 87,000, 87,000 more employees. So you're going to have, you're going to have over 150,000 people, more than that, 190,000 people doing nothing but looking over your shoulder and trying to find stuff. Now, they also will be actively writing revenue rulings, revenue procedures, and other things to interpret this law that's going to get passed. So, what the Democrats and the socialists are doing right now is they're crafting this bill knowing full well that they don't have to say certain things. They can force the IRS to do that. The IRS is more than happy to comply. So this is all tax. Has nothing to do. All of this stuff if it was done outside of tax, would be illegal. For example, there has been some discussion. You've heard a little bit about it. Like I said, it's not actually accurate, I don't believe, and I doubt you'll ever see it in the actual bill itself. But there is a provision in this bill that for any bank account, savings account, money market account, checking account, securities account, money market account at your securities or broker's office, any checking type account, anything like that, Venmo, Zelle, whatever, if you have a balance of $600 or more, not a transaction of $600 or more, a balance of $600 or more, that bank, financial institution, broker, Zelle, Venmo, they have to send the government every single transaction that went through that account. And you're saying, well, that's kind of like the NSA getting everybody's phone calls. There's no way they can go through all of that. You're right. That's true. Although we've got 87,000 more people to do that. And they've indicated in this bill that as part of that, the reason they're providing that money is so that the IRS can audit every tax return of every taxpayer who makes $1 million or more. But they don't know how much money you make until they audit you, because you're not reporting $1 million potentially, right? So, or you've taken some actions that have reduced that. Well, that's why they're going to get all of these transactions from your bank account, because as soon as they select your account, or let me put it this way, vice versa, as soon as they look at those transactions, depending upon the volume of transactions that are going through your account. And by the way, that has to be reported even if it's a transfer to an affiliated account. So for example, when I get up in the morning and go check my bank account, and I go on and I got my electronic banking and I got 6 or 7 business accounts, and I noticed that, my sales tax went through on my one account, and my and then on my other account that I've got some utility bills that have hit. So I know, okay, I've got to take money from this business and I've got to reimburse for those expenses because they were expenses for this other business. So I transfer money through my bank account. That's going to be reported. Those transactions between those related accounts are going to be reported. Even if I was transferring it from a business account in one name to a business account in the same name. Doesn't make any difference. All of those transactions will be reported, and they will report them all outside, inside, everything you do. Now, they're going to use that. First of all, they're going to use it primarily to trigger more in-depth review. If you've got nothing going through your accounts and you got 600 and they know you don't have any money, they're not going to focus on you. They don't have to. But if you've got $2 or $3 million running through your business account in a year, and now that's not income. It's just money coming in, coming out, going out. It's not necessarily net income. It's gross income maybe, but it's not net income. And not all of your expenses are reflected in that bank account. So they're going to show all this money coming in and not necessarily all the money going out. That's maybe in another account that they may or may not know about. It may not be part of this connection. But that's how they're going to do it. And they're going to do it all electronically. So that's why there's other hundreds of billions of dollars going to the IRS for upgrades of computer systems. Where they're going with this, and they can completely do it through the IRS, is they're going to the point that you will not file your own tax return any longer. In fact, that will probably be implemented. That will probably be implemented, I would say, before the next presidential election. Um, and 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 it'll be implemented not to take money from you. They will argue that they're doing it to get money back to you sooner. In other words, what's going to happen is they're going to say, look, we know that a lot of you, you younger people, or those people who are lower income, you don't want to have to pay a CPA. We know this has gotten complicated. We've changed all this tax law. It's very, very involved. But what we're going to do is electronically, we've got the information. We're going to calculate your tax return, and then we'll be able to do that right away by the end of January, or the middle of January. We'll be able to calculate that, and we'll immediately send you your refunds back, or we'll start your credit for the next year for your earned income credit, and your child care credit, and your dependent credits. We'll have been able to calculate that right away, and we'll give you that money back right away. So you won't have to wait. So you don't have to file your tax return. You don't have to pay a CPA. We will help you by doing your tax return for you. And all you'll have to do is just, get your money when you're done. If you've got a problem with it, you'll have to appeal and go through a process, but there won't be any problem because it'll all be electronic and everything will be hunky dory. So, so that's what's happening. What I'm getting at is none of that is in this bill, or has to be in this bill, because the IRS already has the authority to do it. They just don't have the manpower. So can you see how all of this stuff is fitting together now? How that the socialists and the communists within the government, and we have them. I mean, that's a political position. You can have it. Doesn't mean that people agree with you, but it's a political position. That's not, it's not against the law in the United States at this point. So therefore, we have people there that are pushing this agenda. This is how they're pushing it. They have learned that it will never get through the public. People will never, in the United States, having lived in a free enterprise system, in a capitalistic system for this long, and the ability to make your way and set your destiny financially and economically, that whole process, people aren't going to give that up. I don't care what race you are, what nationality you are. I don't care what, that you come from. People that have been in the United States have that innate feeling of freedom and the desire to be successful. That's why we don't want the tax laws to change, even though we may never get the benefit of it. All the time you hear people say, well, you're never going to make $2 million a year. So what do you care that, this isn't going to affect you? And frankly, they count on that. They count on that lack of action on my part. Both parties count on that. They count on you not doing something because it doesn't affect you. The difference is it does affect me. It affects me mentally because I now know that it's not possible for me ever to be successful, even if that happened to be winning the lottery. But it doesn't help me because if I do something and create something, I mean, the Colonel Sanders created Kentucky Fried Chicken at 82 or something. So I'm not 82 yet, so I still have hope. I could do something that results in me making a lot of money, but I don't even care. Even if it's somebody else, it's my kids. I know that my kids, my grandkids, future generations have that opportunity. For me, I don't care if it doesn't affect me. I care that there's that opportunity out there. And as long as I know that opportunity may exist for my kids, I'm 100% behind it, even if it doesn't benefit me at all. Right? And I think there's a lot of people in the country that feel that way, and a lot of older Americans that feel that way. And so when the government looks at this stuff and says, well, it doesn't impact you, what do you care? And that's what they're hammering right now. They're hammering on this. Well, anybody who's under $450,000 or $400,000, this doesn't affect you. Nothing will change for you. Well, first of all, that is a lie. There is going to be significant inflation because we can't pay for all of this stuff. So inflation will attack. It is a tax, even though they don't call it that. So, and they know that. Just like they know a tax can be used instead of a law for universal income or free education, a tax can be used. They also know that they can manipulate uh, the other side of that equation and use inflation to take money away from people who make under 400,000 and under 200,000, and frankly they know that that tax is extremely regressive and affects the lower your income and that you're working, the more inflation impacts you because you can't avoid purchasing things. When your income is only covering the base needs, your car, and fuel that you're getting to work, your food, your medicine, and all of those kind of things. And when all of those things are impacted by inflation uh, and go up, and your salary doesn't go up fast enough to cover it, there's no you're going to pay that tax burden because now you have less, and you end up with the inability to buy. Um, so, and that's coming. We all know that's coming. In fact, what's scary about this is that we can't get people to come back to work. Uh, there's a large group of people that have left the workforce. Well, why is that? I think some of them are sitting on the sideline to see whether or not they want to reinvest their personal capital into this economy going forward. Some of them may permanently retire. Some of them may move into the underground economy, which is now going to be harder to do because of the ability to look at your bank account. So there's going to be some of that, and there are a lot of people that are just trying to figure it all out. But at the same time, businesses are not paying. They're being forced to pay a higher salary. Nobody's talking minimum wage anymore, right? Nobody wants to be paid minimum wage now because that's not enough. For most Americans, minimum wage is not enough. Why? Because we have an underlying inflation that's up into the teens. I mean, you can say it's not. People are looking at, but they carve out. You know, the inflation this last month under the consumer price index as adjusted for a basket of goods, that's whatever their analysis is. It was like 5.6%, 5.6. And they say, oh, okay, 5.6. Oh, geez, maybe this is short term. Hopefully this is short term. And but that takes a whole bunch of stuff out of it. It leaves out gas and food. And wait a minute, what? It leaves all this stuff out of it. It not included in the calculation. Well, what were those increases? 40%, 15%, 18%. Those numbers were all well up into the double digits. So why are people not eager to jump back into a job at $15 an hour? Because they know already they can't afford that, doesn't get them enough money to live. So they would just as soon wait on the sidelines and hope the government's going to give them that money than to go out and take a job where they're working and having to go to work every single day, faced with potentially coronavirus or whatever else, whatever their reasons are, and they're going to have to go out in that environment, work every day, and they don't have any, and they're going to have less than if they did nothing. I mean, if they did nothing, they're going to have almost the same basket of service, not quite, but they're not going to pay any taxes, and they're not going to have to work, and they can probably go do something on the side, take some gig work and make $100 or $200. And you know what? If you make under 400, you probably won't even have to report it. So that's what's happening. We have that underground economy that's already out there. I don't know how many times now that I get questions about will you take more? I mean, will you take less if it's cash? That's becoming a common question now. Why? Because people are already afraid of what the tax laws are going to be. They're already not making, they know if they take a standard job where they have to pay taxes, even if they're not affected, so to speak, it's not giving them enough money to keep up with inflation. So we're already there. We're already at the point where the income side of it is not keeping up with the inflation side. And that never does. Labor is always the last to come to the table. Nobody ever rewards labor first. It's always the inflation that hits and the other things that go up. And labor only goes up when when prices can go up enough to cover the labor. So initially, businesses don't want to increase prices because it makes them less competitive. But once they get to that point where they can increase prices, then they can start looking at labor, but never before. They're not going to do the they're not going to do the labor increase before the inflation. It's usually something else that's creating the inflation. In this situation, it's taxes, and it's oil and gas that are creating the inflation. It's material costs. So, like I said, every corporation has the same basic costs. They have materials, they have labor, um, they have equipment, which I consider part of materials sometimes, equipment, and then they have taxes and they have return on the investment. Those numbers, all of those numbers can potentially change except return on investment. Return on investment can only go up, which means the other costs have to go down or price has to go up. The only way it but and price has to go up faster than inflation, because if price doesn't go up faster than inflation, then the return to the investors is going to be less than it was previously. That number can never be less because investors will leave. They will not pay it. They will go. And you say, well, those investors, they're fat cats sitting at home collecting their coupons, clipping their coupons, collecting their stock payments. Absolutely not. They are absolutely not. They are you. If you have an IRA account, that's you out there saying that. You're the one saying, I'm not staying in Ford if I'm going to get less than General Motors or less than Tesla. That's you. That's your labor union too. That's your teachers union. That's where that money is. They're the biggest investors in the United States. You think they're going to sit there and take a lower yield and have, because what's going to happen? If they get a lower return, their retirees are going to be really ticked. They're out. The union leaders are going to be gone. The investment managers are going to be gone. But also, what's going to happen? Well, if retirement isn't going to be high enough, then that's the money that's going to pay these people in retirement. So what has to happen? Well, teacher salaries have to go up. Well, they're already trying to get teacher salaries up. That's not happening. So you're going to lose. So that's why it isn't going to happen, because the people that control that are not going to let it happen. It's a publicly traded company. They can move to somebody else that they can make a better yield for. Now, the exception to that is for small business, because in small business, the owner pays the taxes. It's an individual tax, not a corporate tax. And that's the difference. That is the difference. Corporations do not pay taxes, individuals pay taxes. So that means individual small business is paying a large chunk of the taxes. And that's the sad thing that a lot of people don't realize, is that is small, basically mom and pop businesses. I'm talking about businesses that are doing 20 or 30 million dollars or less in total revenue. Their net income may be as high as a million and a half, $2 million. But you say, well, okay, but with but they're paying a much higher percentage of even the wealthy taxes, because they can't change their income stream. They can't move their income from their business into tax-free income. They can't. You can't all of a sudden be tax-free. You don't have the cash, first of all. And second of all, your business is what's generating the income. So you can't do anything about it. You can't change the character of it. And in fact, if the government arbitrarily changes the character of it, which they're doing in this tax bill, for example, by saying, well, if you've got an S corp or an LLC taxed as a partnership, those distributions that you were getting before were subject to tax, but they were not subject to Social Security taxes. Now they are. So the character of that income went from basically a active participation type income that's not subject to self-employment tax or Social Security taxes to earned income, regardless of how much it is. It's all earned income. It's all as if you had a salary. Well, that's nice, except that when I get a salary, I get it in cash. It all comes in cash. This earned income doesn't come in cash. So I'm now getting taxed on Social Security tax on income that I don't have the cash. The cash is in my business. Well, it won't be for very long. I'll have to get it out of my business. And what I'll have to do is do something. I'll have to get rid of some of my inventory. I'll have to stop taking jobs. How many businesses out there right now have stopped writing new work because they can't get the product, right? That's a problem right now. So we've got this huge, what we consider to be an unmet demand because you can't get the product. But even if you can get the product, now that the market is the way it is, how hard is it to get somebody to do that and to provide that product when there's a shortage? Well, it's really hard. Right now, try to go get an air conditioner installed, right? It's difficult. You can get an AC person, but they may not be able to get an air conditioning unit for months. And so it could be and that's a problem, right? So now what are they going to do? Well, if they know that they're going to have to wait 4 months to install a new AC unit, they're going to do one of two things. They're either going to go out and buy a cheaper AC unit and convince the customer that's the way they need to go, right? And that they can get that installed right away. And then they make more money because they're going to not change their price. But then second of all, if they're not going to be able to get that product installed in 4 months, and let's say it used to be that they could get that AC in I'm going to make the calculation. Let's say it was a month, and that's long. It probably was 3 days. So if they're selling one AC unit every 3 days because they can get it, and now they can only sell one every 4 months because they can't get it, what are they going to do to the price of the AC unit? Well, they have to increase it, not just by